Imagine watching your property empire teeter on the brink of collapse. This was the reality for one landlord facing receivership, with vacant units threatening cash flow and portfolio stability. Swift action was crucial to prevent asset liquidation. Without intervention, years of careful investment could dissolve, leaving properties sold at reduced values. The clock was ticking. Refinancing a mixed-use property portfolio is no small feat. Each property needed individual evaluation, with the challenge of dealing with multiple local property markets. Vacant units added uncertainty to future income projections. Convincing a new lender of the potential for stabilization was essential, despite the current performance. The solution was a £2.4 million refinancing deal. A short-term facility with a 6-month term provided breathing room for stabilization. Security arrangements included first legal charges and personal guarantees. The loan-to-value ratio was carefully calibrated, balancing risk with the need for capital. The landlord's strategy focused on stabilizing the portfolio within 6 months. Flexible letting terms and targeted improvements increased marketability. The transition plan aimed for a conventional term refinance, reducing financing costs while preserving the portfolio intact. Specialist bridging brokers and lenders are rising in complex cases. A holistic portfolio approach offers benefits over individual solutions. Timing is critical in distressed property scenarios. Execution speed can be as important as the terms of the facility itself. Diversification requires financial resilience. Maintaining relationships with multiple financing sources provides crucial options when conventional funding disappears. A clear stabilization plan is essential in distressed refinancing. By doing so, you'll position your portfolio for future stability and success.